Okay, so actually I'd like to use a very simple business idea to illustrate what is the difference between equities. What we call stocks is equities, equities and bonds. Imagine if you want to set up an ice cream store, so to set this up you need $1,000, and assuming, let's say you manage to sell $1,000 worth of ice cream in a particular period of time. Now, assuming that your net profit is $400, very simple, it's just what you make minus of what you pay, your net profit is $400. Okay, very simple. Let's say business is so good that you feel they have identified another corner of the street where you feel you can also capture more of the ice cream demand down there. But the problem is you need to have an additional $1,000. Now there are a few options that you can do. Okay, number one, you can borrow it from a bank, or you can go to the bond market. But of course, let's assume because bond market usually they don't deal in $1,000 online. Let's say it do just as well as your first card. And so everything you have to do is just to multiply by 2. So last time the first card is 1,000, you made a revenue of 1,000. Now if you have 2, you make 2,000. Very simple, 1,000 each. And the ingredients, assuming nothing changes, you should be able to maintain the same kind of cost. And therefore your profit is 800. And the difference now this time is your second card, you went to borrow money from someone. And the interest rate, assuming let's say it's very easy, let's make it at 10%. And the interest rate is $100, right? Because you borrow 1,000, 10% of 1,000 is 100. So you minus off that as interest payment, your net profit is actually 700. So you have actually grown your profits by nearly twice. Now, second option, if you don't want to borrow from the bank, so what you can do is you can bring in a shareholder. Okay, means you start to sell a share of your company to someone else. And what happens is you used to own one share, but now you split that one share with another investor. So that means you used to own one share for $1,000 because that is your first ice cream cart that you invested in. Now you sell the ice cream cart, the share of the ice cream cart to another investor who have agreed to put in $1,000 as well. So since both people has put in the same amount of money, technically they have equal shares. Now that you have 2 shares, one for yourself and one for the external investor, the profit divided by 2 is 400. And of course, if business expands, each card now can make 1,005, then minus off the cost, the profit is now 750 per share. But of course, the business has grown. Overall, the 2 cards has a net profit of 1,005, but because there's now 2 shares, each person get 1 share of the profits, which is 750. But what if, now let's talk about when times are good, but what if when times are bad? Let's say you overestimated the demand. You felt that you by buying another card, you can actually capture the same amount of demand. But what if actually you have overestimated it, and actually the number of people who want to eat ice cream is not as much as you think? And as a result of that, what you used to earn 1,000, now because the supply has increased, you have actually managed to capture only 750 per card. So what happens in this case? If the revenue, okay, again, like you see most businesses, if revenue is lower than expected, cost tends to remain about the same one. And for instance, let's say and that makes sense. Imagine, let's say you are an ice cream owner, you have to invest first to make the ice cream, right? And if the ice cream don't sell, it's too late. It's already sunk cost already. You cannot like say that, oh, if I sell more or less, the cost will be different. No, it's about, usually there's always, for any business, there's always a certain amount of fixed cost. And that is the fixed cost that I'm talking about here. And therefore, when you look at the costing, it's actually about the same from last time if you have sold more. Okay, and I think it's easier to understand because imagine, let's say you're an ice cream owner, you have to make the ice cream first, and you have to maybe give people a choice of at least 4 to 6 flavors, right? And so this is in a way acts like your inventory. Okay, whether you sell or not, the cost has already been sunk already. It's too late to recover them. So in this case, as a profit is now a lot lesser, only $300. And assuming if you had borrowed money from the bank or investor, you still have to pay the interest payment of 10%, right? And the net profit now becomes a lot lower, 200, worse off than if you had one card only, right? So that's the difference. if you are a shareholder versus an interest payment for a bond investor. Now, same thing here. If you let's say you never borrow money, what you did was to ask someone else to invest in your business. Then similar calculations. Each card only managed to make 750, and the profit now has shrunk from 400 to 300. Okay, but because the business has shrunk, divided by the number of 2 shares, each share is only 150. Okay. And then you compare. Let me show you how it looks like. If you are a bond investor, imagine if let's say you are someone thinking about this business opportunity. This friend came to you and tell you, can I borrow $1,000 from you to set up this ice cream cart? Now, the question now is, would you want to lend him as a bond, as a loan, or would you want to be a shareholder in his business? And the answer to that depends. Because if you look at the kind of scenario testing that I've just shown, when times are good, and if you expect the company to do well, even better than where it is today, the answer is actually you should be actually investing in as a shareholder, because your returns as a shareholder is a lot more. Now, if you are not as confident, then I think the answer is you should be actually lending to him as a loan rather than as a shareholder, because as a loan, you actually have more certainty of returns, even if the company don't do well. And that is my point to people, is if you look at how, as a shareholder, why is it that share prices are a lot more volatile than fixed income? That's because in any business, is the earnings, the shareholders are actually entitled to whatever that is left behind after you deduct all costs and expenses, and this includes fixed costs and variable costs. If you think that revenue will grow, business is growing and growing faster than costs, then you should be the last guy to take the remainder, because that will give you usually a lot more money. Now, compared to, let's say, if you are not sure, then you should be actually queuing in front of everyone else, which is what a bond investor really is. A bond investor gets fixed returns. In exchange, he also, in the event that the company don't do well, in the event that the company is liquidated, let's say the ice cream store went bankrupt and they have to sell the cart to someone else, then he actually gets first priority to get paid back his money. Okay, so that's the difference between a stock and a bond investor. The bond investor obviously is a lot more risk averse. They cannot tolerate so much risk. They only want a fixed payment, and in the event the company fails, they actually get first rights to any proceeds by selling the ice cream cart. So very, very safe. Okay, but whereas if you want to take more risk, then you should actually be a shareholder. A shareholder, if when a company do well, you do a lot better compared to a bond investor. Okay, so that's the 2 points I want to give you. The range of returns for stockholders are a lot more variable. Okay, and that also means why stock prices tend to be more volatile than bond prices. And then I'll talk about currencies now. There is only 7 major currencies that you see that are traded almost on a daily basis. So you can just read them off the list there. US dollar tends to be the largest because it's the international reserve currency. Okay, and some of the factors that people always look at to affect currency is, of course, interest rates. Different countries have different currencies have different interest rates. Of course, geopolitics also. Now, if you look at commodities, they are not a so-called a natural asset class. What do I mean by natural? Because if you buy a stock or a bond, you get dividends, right? If you buy a stock, you can get dividends from the profits. If you buy a bond, you get interest from the interest payments. Okay. Now, whereas commodities, there's no such thing. You hold gold doesn't mean you will get small little streams of gold every year. You don't get paid for holding commodities. And the only reason you will buy commodities is you expect the commodity price to go up in the future. In commodity trading, what is most important is the supply and demand.